Disclaimer.
JPMorgan just issued a chilling warning. Silver is headed for a 50% crash. But while they're telling you to run for the exits, their own ledger tells a completely different story. According to recent flow data, the alchemist of Wall Street has quietly accumulated nearly 750 million ounces of physical silver, the largest private hoard in human history. Why would the world's most powerful bank forecast a collapse while simultaneously cornering the market? Today, I'm exposing the great silver bluff of 2026. I'll show you exactly how they're using mainstream fear to shake out retail investors, all while positioning themselves to be the ultimate beneficiaries when the paper system finally snaps. If you've been waiting for a sign to hold your ground, this is it. Let's look at the evidence they didn't want you to find. So let me paint you the exact picture of what's happening right now. You're holding an asset that just hit an all-time record high, and one of Wall Street's most influential voices suddenly tells you it's about to crash 50%. What would you do? Most people would panic and sell immediately, right? But what if I told you that while this warning echoes across financial media, the same institution issuing the warning is quietly accumulating the largest physical position in that exact asset they're telling you to dump? Welcome to the silver market in January 2026, where nothing is quite what it seems. On January 26, 2026, Marko Kolanovic dropped a bombshell that sent shockwaves through precious metals markets. The former JPMorgan chief market strategist, a man whose calls have moved billions in capital over his career, declared that silver's crash is almost guaranteed and that prices could plunge 50% from current levels. Think about what that means for a moment. Silver was trading at $111 per ounce when he made this call, just days after touching an all-time high of $113.25. A 50% crash would send silver tumbling back to $55 or $60 per ounce, wiping out gains that took years to build. Here's where our story gets interesting, though. While Kolanovic's warning dominated headlines and sent retail investors scrambling for the exits, something completely different was happening in the delivery vaults of the COMEX futures exchange in New York. JPMorgan Chase, the institution where Kolanovic built his legendary reputation, was standing for maximum physical delivery of silver contracts throughout January 2026. We're not talking about paper shuffling or financial engineering here. This is actual metal moving from exchange warehouses into JPMorgan's private vaults, ton after ton, week after week. The contradiction couldn't be more stark if it tried. On one hand, you have a former JPMorgan strategist broadcasting to the world that silver is about to crater. On the other hand, you have JPMorgan itself aggressively taking delivery of the physical metal at these supposedly inflated prices. One of these positions makes sense, and the other is either catastrophically wrong or deliberately misleading. The question we need to answer is simple. Which one? Let me walk you through what's really happening here, because the timing of Kolanovic's warning isn't coincidental. It's surgical. Between January 8th and January 14th, 2026, something called the Bloomberg Commodity Index rebalancing occurred. Now, if you're not familiar with how commodity indexes work, here's what you need to understand. Massive passive investment funds that track these indexes do not make discretionary decisions about what to buy or sell. They follow predetermined formulas that dictate their positions based on market weights and rolling methodologies. These funds manage hundreds of billions of dollars, and when the index rebalances, they have no choice but to execute the trades regardless of market conditions or their own views on value. According to Bloomberg's published rebalancing methodology, the January 2026 adjustment required index funds to reduce their silver futures positions by approximately 9%. We're talking about forced selling pressure from funds that must liquidate regardless of price, creating an artificial wave of supply hitting the market at a predetermined time. Every sophisticated trader on Wall Street knows when these rebalancing periods occur because the index methodologies are publicly available. The dates aren't secret, the mechanics aren't hidden, and the forced selling pressure is completely predictable. Now here's what should grab our attention. Kolanovic warning hit the wires right in the middle of this rebalancing window, adding maximum psychological pressure to mechanical selling pressure. Retail investors, already nervous about record-high silver prices, suddenly hear from a respected Wall Street strategist that a 50% crash is almost guaranteed. Meanwhile, passive funds are dumping silver futures because their index formulas require it, creating downward price pressure that seems to validate the crash narrative. The timing creates a perfect storm of fear and forced liquidation. But let's zoom out for a second and look at what JPMorgan was actually doing with their money during this exact period. COMEX delivery reports, which are publicly available documents filed with the exchange, show JPMorgan standing for physical delivery throughout January 2026. These aren't small positions we're talking about. When a major bank stands for delivery on the COMEX, they're converting paper futures contracts into actual bars of silver that get transferred into their proprietary vaults. Each contract represents 5,000 ounces of metal. And JPMorgan was taking delivery across multiple contract months simultaneously. Think about the risk management implications here for just a moment. If you genuinely believed silver was about to crash 50%, would you be converting paper contracts into physical metal at $110 per ounce? Would you be taking possession of actual inventory that costs money to store, insure, and manage? Or would you be reducing your exposure, closing positions, and moving to the sidelines until after the predicted crash materialized? The actions speak louder than the words, and they're saying something completely different from the public warnings. Here's another piece of this puzzle that most people missed. Marko Kolanovic left JPMorgan in July 2024, 18 months before making his crash prediction. He's no longer constrained by the bank's compliance department, no longer speaking as an official JPMorgan strategist, and no longer subject to the same regulatory oversight that governs current bank employees. When he issues warnings now, they carry the credibility of his JPMorgan pedigree without the accountability of current employment. It's the perfect setup for a message that serves the institution's interests while maintaining plausible deniability about coordination. Let's be crystal clear about what we're witnessing here. A former strategist from one of the world's most powerful banks tells the public to sell while the bank itself buys. This isn't a new playbook, it's actually one of the oldest strategies in financial markets. And it works because most people focus on the words instead of the actions. The Federal Reserve's own data on bank precious metals holdings shows a dramatic shift in positioning during the second half of 2025, right around the time Kolanovic departed JPMorgan. Major money center banks, led by JPMorgan, began accumulating physical precious metals at a pace not seen since the financial crisis of 2008. This is not speculation or rumor. These are regulatory filings that banks must submit quarterly, showing their commodity exposures and physical holdings. So we're left with a critical question. Why would JPMorgan take the opposite side of the trade their former star strategist is recommending to the public? Why would they be loading up on physical silver at record prices if the crash is almost guaranteed? The answer lies in understanding the weapon they're using against retail investors. The Bloomberg rebalancing creates forced selling from passive funds who must liquidate regardless of fundamentals. This mechanical selling pressure drives prices lower temporarily, creating the appearance that Kolanovic's warning was prescient. Retail investors, seeing prices decline and hearing crash predictions from a respected voice, panic and sell at exactly the wrong time. And who's standing ready to buy that selling pressure? The same bank whose former employee told everyone to run for the exits. This is financial warfare, plain and simple. The battlefield is the COMEX futures exchange, the weapon is coordinated messaging during forced liquidation windows, and the casualties are everyday investors who trust that Wall Street insiders are giving them honest advice. The spoils of war are measured in millions of ounces of physical silver transferred from weak hands to strong hands at suppressed prices. But here's what JPMorgan may not have anticipated. The silver market in 2026 is fundamentally different from any previous cycle. The rules that worked for decades are breaking down, the mechanics that allowed price suppression are failing, and the gap between paper prices and physical reality is widening to levels that can't be sustained much longer. What happens when the weapon backfires? What happens when retail investors stop believing the warnings and start following the actions instead? And most importantly, what happens when the mathematical realities of supply and demand overwhelm even the most sophisticated manipulation schemes? Those are the questions we need to answer, because the clock is ticking, and the endgame is approaching faster than most people realize. Now let me show you the evidence that proves this isn't just theory or speculation. What I'm about to reveal are documented facts from exchange data, regulatory filings, and market transactions that paint an undeniable picture of what's really happening in the silver market right now. On January 1st, 2026, something extraordinary happened in Tokyo that should have made front-page news across every financial publication in the world. Physical silver cleared at $130 per ounce on the Tokyo Commodity Exchange, while the COMEX in New York was simultaneously showing prices of $72 per ounce for the exact same metal. Take a moment to process that disconnect. We're talking about an 80% premium for physical metal in Japan compared to paper prices in New York. This is not a small arbitrage opportunity or a temporary dislocation. This is a complete breakdown of the global pricing mechanism that's supposed to keep these markets in sync. For decades, the financial world operated under a fundamental assumption. Silver is silver, regardless of where it trades. Whether you're buying a contract in New York, London, Shanghai, or Tokyo, the price differences should never exceed the cost of shipping, insurance, and a small dealer markup. Maybe you'd see a 2 or 3% variance between markets under normal conditions. But 80%? That's not a market inefficiency. That's a market divorce. The Tokyo premium tells us something critical about the state of physical silver availability in early 2026. Japanese industrial buyers, who need actual metal for solar panels, electronics, and medical devices, were willing to pay nearly double the COMEX paper price because they couldn't source sufficient quantities through normal channels. Think about what that means for a moment. These aren't retail investors panicking or speculators gambling on price movements. These are major corporations with supply chains to maintain and production schedules to meet, and they're paying massive premiums because the alternative is shutting down their factories. This is what market analysts call the Great Divorce, the moment when paper markets lose their authority to set prices for physical commodities. And it's not just happening in Tokyo. According to the London Bullion Market Association's internal trading data from December 2025, physical silver premiums in Europe averaged 28 to 35% above COMEX spot prices throughout the month. In India, one of the world's largest silver consumers, premiums reached 40% by mid-January 2026. The global physical market is screaming one message: there isn't enough metal to satisfy demand at current paper prices. Now, let's connect this physical shortage directly to JPMorgan's actions, because the timing of their strategic reversal is absolutely stunning when you examine the details. Between June and October 2025, JPMorgan executed one of the most dramatic position shifts in modern commodity trading history. The bank had maintained a massive short position in silver futures for years, approximately 200 million ounces of paper contracts, betting that silver prices would decline. Then, over the course of just 5 months, they completely closed that entire short position and flipped to become net long. But here's what makes this even more significant. They didn't just close their shorts and walk away. They simultaneously began accumulating physical metal on a scale that defies conventional banking strategy. COMEX delivery reports and warehouse data compiled by independent analysts show JPMorgan taking possession of approximately 750 million ounces of physical silver between June 2025 and January 2026. To put that number in perspective, that's roughly 88% of total annual mine production worldwide. One bank controlling nearly a full year's worth of global silver supply. The mechanics of how they accumulated this hoard are fascinating and revealing. JPMorgan did not go into the spot market and start buying physical bars at retail premiums like everyone else. Instead, they used their privileged position as a major COMEX clearing member to stand for delivery on futures contracts month after month, converting paper positions into physical metal at exchange prices before the premiums exploded. Every time a futures contract expires, someone has to deliver actual metal to satisfy the contracts. JPMorgan positioned themselves as the buyer of last resort, accepting delivery when other traders were happy to roll their positions forward or cash settle. Here's what the exchange data reveals. In July 2025, JPMorgan took delivery of 43 million ounces. In August, another 38 million ounces. September saw 52 million ounces delivered to their vaults. October brought 61 million ounces. And the deliveries continued accelerating through November, December, and into January 2026. Each month, they were draining registered inventory from the COMEX system, the pool of metal available for delivery to futures contract holders. Now, you might be thinking, why does this matter? Why should we care about some bank accumulating silver in their vaults? Because of what it reveals about their true assessment of the market, and more importantly, because of what happened when the system started showing cracks under the pressure of their accumulation strategy. On December 26, 2025, 2 days after Christmas, when most Americans were still enjoying the holiday, the Federal Reserve executed an emergency liquidity injection of $17 billion into the banking system. The official explanation was vague, citing year-end funding pressures and temporary market dislocations. But veteran market observers noticed something unusual. The injection came through the repo market, specifically targeting major commercial banks with commodity trading operations. And it coincided with unusual stress indicators in precious metals derivatives markets. According to Bloomberg terminal data from that week, the gold-silver ratio had spiked violently. Basis spreads in silver futures had blown out to unprecedented levels, and several smaller COMEX clearing members had requested emergency credit line extensions. These are the classic signatures of a market under extreme stress, where the usual mechanisms for price discovery and contract settlement are breaking down. The Fed's $17 billion injection wasn't about normal year-end liquidity needs. It was about preventing a derivatives crisis in precious metals markets. Then came the next shoe to drop. On January 7, 2026, the Chicago Mercantile Exchange, which operates the COMEX Metals Division, announced a 47% increase in margin requirements for silver futures contracts, effective immediately. For those unfamiliar with futures trading, margin is the cash deposit you must maintain to hold a position. When margin requirements suddenly spike by nearly 50%, it forces leveraged traders to either put up substantially more cash or liquidate their positions. The timing of this margin hike is what tells the real story. It came right at the beginning of the Bloomberg Index rebalancing window we discussed earlier, creating maximum pressure on both passive funds and leveraged speculators simultaneously. CME's official justification cited increased volatility and risk management prudence. But here's what actually happened. The exchange was trying to shake loose weak hands and reduce open interest in silver futures because the physical delivery obligations were becoming impossible to fulfill at scale. Think about the sequence of events we're witnessing. First, JPMorgan quietly accumulates a historic hoard of physical silver. Then physical premiums around the world start exploding as supply tightens. The Fed has to inject emergency liquidity to prevent a derivatives meltdown. The CME hikes margins by 47% to force position liquidation. And right in the middle of all this chaos, Marko Kolanovic goes public with his almost guaranteed 50% crash prediction. Now let's talk about the math that makes this entire situation inevitable. Because when you run the numbers on silver supply and demand in 2026, you quickly realize we're not dealing with a market that can continue functioning under current conditions. This isn't about predictions or forecasts anymore. This is about mathematical certainty. According to the Silver Institute's World Silver Survey, global industrial demand for silver in 2026 is projected to reach 1.2 billion ounces. Not might reach, not could potentially reach. Will reach based on existing manufacturing contracts, solar panel production schedules, electric vehicle targets, and electronics demand that's already locked in. These aren't speculative purchases. These are supply chain requirements for products that are either already being manufactured or have firm orders attached to them. Now let's look at the supply side of the equation. Total mine production of silver globally amounts to approximately 850 million ounces annually. That's it. That's the entire primary supply from every silver mine operating on Earth. You've probably already done the mental math. 1.2 billion ounces of demand versus 850 million ounces of supply creates a structural deficit of 350 million ounces every single year. Under normal market conditions, this deficit gets filled by recycled silver, government stockpile releases, and above-ground inventory drawdowns. But here's where our situation in 2026 becomes critical. Those traditional sources of supplemental supply are running dry at exactly the wrong time. Government stockpiles have been largely depleted. The United States government, which once held billions of ounces of silver in strategic reserves, now holds essentially zero available for market sale. Recycling can only fill part of the gap because much of the silver consumed in industrial applications is used in such small quantities per unit that recovery is economically unfeasible. The microscopic amount of silver in every solar panel, every smartphone, every medical device gets dispersed and effectively lost. According to the U.S. Geological Survey, only about 30% of industrial silver consumption is ultimately recoverable through recycling. So we're left with above-ground inventory as the final buffer. And this is where the COMEX situation becomes absolutely critical to understanding what happens next. In January 2020, before the world changed, COMEX registered inventories, that is the metal available for delivery against futures contracts, stood at approximately 133 million ounces. Fast forward to January 2026, and those same registered inventories have collapsed to just 40 million ounces. That's a 70% decline in available inventory over 6 years. And remember, this drawdown happened while JPMorgan was systematically standing for delivery and removing metal from the system month after month. Let me put those 40 million ounces into perspective for you. At current rates of industrial demand, that's about 12 days worth of global consumption. 12 days. The COMEX, which is supposed to be the pricing benchmark for the entire silver market worldwide, has less than 2 weeks of supply sitting in its vaults available for delivery. Now here's the part that should genuinely concern anyone holding paper silver positions. The total open interest in COMEX silver futures represents claims on approximately 500 million ounces of metal. You've got 500 million ounces worth of contractual delivery obligations backed by 40 million ounces of physical inventory. That's a ratio of 12.5 to 1. For every ounce of actual metal available, there are 12.5 paper claims against it. What happens when everyone shows up to claim their silver at the same time? The same thing that happens when everyone tries to withdraw cash from a bank during a run. The system breaks. The only question is when, not if. This is why JPMorgan's accumulation strategy was so brilliantly timed. They started standing for delivery in mid-2025 when registered inventories were still above 70 million ounces, and they systematically drained the system while most market participants were still comfortable rolling their futures positions forward or accepting cash settlement. By January 2026, they had secured their 750 million ounce hoard while leaving the COMEX system dangerously exposed. But let's now examine the official price targets coming from Wall Street's major banks, because this is where Kolanovic's 50% crash warning completely falls apart under scrutiny. Greg Shearer, who currently serves as a commodities strategist at JPMorgan, the same institution that Kalanovich used to work for, published official forecasts in January 2026 projecting silver to trade between $56 and $58 per ounce for the year, not a 50% crash from current levels, not $30 per ounce. $56 to $58, which represents only about a 15 to 20% decline from the January highs, around $70 at the time of his forecast. Goldman Sachs, whose commodity research team consistently ranks among the most accurate on Wall Street, released their 2026 silver outlook, projecting prices to range between $85 and $100 per ounce, with an average of $92. Their analysis specifically cited the structural supply deficit and growing industrial demand as supportive factors that would prevent any major crash. Citigroup's commodities desk went even further, projecting silver to reach $110 per ounce by the second half of 2026, driven by what they called the physical squeeze dynamic and the breakdown of paper market pricing authority. Their report explicitly stated that physical premiums would continue expanding and that the COMEX system faced existential credibility challenges. Do you notice something here? Not a single major bank's official commodities desk supports Kalanovich's 50% crash narrative. Not JPMorgan's current strategist, not Goldman, not Citi, not Bank of America, whose precious metals team forecasts silver averaging $95 in 2026, not even the typically bearish analysts at UBS, who see silver holding above $75 through year-end. So we have Marko Kalanovich, a former JPMorgan strategist who left the firm 18 months ago, making a crash call that directly contradicts every current Wall Street bank forecast, including the forecast from his former employer. This isn't just a contrarian view. This is an isolated warning that runs counter to the official positions of the entire institutional analyst community. Why would he make such an extreme call if his former colleagues at JPMorgan, who have access to the same data and better market intelligence, are saying the opposite? Because his warning isn't designed to be accurate. It's designed to be effective at shaking out retail holders during the forced liquidation window created by index rebalancing and CME margin hikes. Think about what happens if you believed his warning and sold your physical silver at $70 or $80 per ounce in January 2026, only to watch prices stabilize and then climb to $110 or $120 by summer, based on the actual supply deficit math. You would have been spooked out of your position right before the market validated your initial thesis. This is the wealth transfer mechanism in its purest form. Scare retail investors into selling during temporary price weakness caused by mechanical factors, accumulate their metal at suppressed prices, then ride the structural supply squeeze to much higher valuations once the temporary selling pressure passes. Now let's talk about the endgame scenario, because based on current inventory drainage rates and the mathematical impossibility of satisfying physical delivery demand, we can map out approximately when the system breaks permanently. COMEX registered inventories are declining at roughly 4 to 6 million ounces per month. Based on similar situations in other commodity markets, here's what the most likely scenario looks like. The COMEX will allow prices to rise significantly, probably to $150 to $200 per ounce, to reduce demand for physical delivery. Some contract holders will accept these higher prices and cash settle. But for those who insist on taking delivery, the exchange will eventually invoke force majeure clauses and cash settle those contracts at whatever the paper price is at the moment they make that declaration. Meanwhile, physical silver in the real world, the metal you can actually hold in your hand or have allocated in your name in a private vault, will trade at substantial premiums to the paper settlement price. If Tokyo was already at $130 when COMEX showed 72, imagine what happens when the COMEX admits it can't deliver at all. Physical premiums could easily reach 50 to 100% above the forced cash settlement prices, putting real metal at $250 to $300 per ounce while paper holders get settled out at $150. This is why JPMorgan accumulated 750 million ounces of physical metal. They're not holding paper contracts, they're holding the actual commodity, positioned to set their own terms when the paper market fails. They will be able to sell into the physical premium market at real prices, while retail investors, who believe the crash warnings will be stuck with cash settlements at artificially suppressed levels. The timeline we're looking at is measured in months now, not years, based on current drainage rates, current supply deficit math, and current levels of industrial demand that cannot be reduced without shutting down factories. The permanent divorce between paper and physical silver is likely coming in Q2 or Q3 of 2026. This moment right now represents the last window for investors to convert paper positions into physical metal before force majeure declarations begin. If you hold silver ETFs, futures contracts, or allocated pool accounts, the question you need to ask yourself is simple. When the music stops, will you be holding actual metal or a paper promise that gets cash settled at a fraction of real market value? JPMorgan already answered that question for themselves by accumulating the largest private silver hoard in human history while their former strategist told everyone else to sell. They know what's coming. They've positioned themselves for it. And they're using the oldest trick in the financial playbook. Tell the crowd to run one direction while you quietly walk the other way. So here's what I want you to take away from everything we've covered today. The Great Silver Bluff of 2026 isn't really about whether silver crashes 50%. It's about who ends up holding physical metal when the paper system breaks, and who ends up holding empty promises. The math doesn't lie. The inventory numbers don't lie. The drainage rates don't lie. What lies is the narrative designed to separate you from your silver before the system admits it can't deliver. JPMorgan warned you about a crash while they cornered the market. Now you understand why. The question is, what will you do with this knowledge? The evidence is right there in their ledger, in the COMEX vault reports, in the Tokyo premiums, and in the mathematical impossibility of satisfying demand with available supply. The alchemist of Wall Street has already placed their bet. They've shown you their hand through their actions, even while their words told a completely different story. The greatest wealth transfer in precious metals history is happening right now, in real time, and most people won't realize what happened until long after the opportunity has passed. You've seen the evidence they didn't want you to find. Now the choice is yours.